Hello and welcome to my May Economic and RBA update. And in this month, I'm focusing in on another banking issue in the US. The RBA makes another close call today. I'll also touch base on the release of the RBA review. Are they fit for purpose? And finally, in my property update, I'm going to be talking about the current inflection point in the market. Plus, I also am going to take a deep dive into rental yields because we haven't done that for a while. So let's roll into the show, starting with an update on the US economy. What did we learn from the past month? Well, as I mentioned, the US has another banking issue, and the regulators are working hard to avoid any contagion in the banking sector. That's following the collapse of two banks so far this year. We saw Silicon Valley Bank collapse on the 10th of March and the Signature Bank on the 12th of March. This time around, it's the San Francisco-based First Republic Bank. In their recent earnings report, deposits fell by 41%, which indicates a clear run on the bank is underway and its share price has collapsed. Now, at the time of recording this update, the regulators were working on a sale to one of the big US banks. So it's clear that the days of this bank being a standalone bank are numbered. Now, the US regulator continues to try to move fast in its attempt to get confidence and trust back in the US banking system. So far, it appears to be working as investors and bank stocks on the US stock market are holding up for now. Now, confidence and stability are still under question, and there is more work to be done by the US regulators to shore up this story. As I've mentioned recently, there is still talk of problems in commercial property sector, which could expose more banks to losses and downside risks. Let's keep an eye on this as it plays out over the coming months. Okay, let's move on now and let's look at the economic data coming out of the US for the past month, starting obviously with inflation. Now, headline inflation numbers in the US slowed in the March quarter. The monthly pace of inflation slowed to 0.1% in March, down from 0.4 in February. Annual inflation dropped from 6% in February to 5% in March. Continued monthly declines in energy and used car prices, negative 3.5 and negative 0.9 respectively, continued the disinflation in the headline rate. Now, in terms of the core inflation, which excludes the volatile items of food and energy, this has unfortunately remained elevated. Core inflation rose by 0.4% in March and 5.6% over the year. This followed a monthly outcome of 0.5 and an annualized pace of 5.5 in February. This means the monthly figure dropped by 0.1%, but the annualized pace increased by 0.1%, meaning core inflation isn't moving down as quickly as the Fed would like, remembering they have a 2% inflation target. In support of their concerns, the super core measure, which removes the shelter costs in addition to food and energy, rose by 0.3% in the month. This was an acceleration from 0.2% over the previous 2 months and 0.1% increases from October through to December last year. In fact, on a 3-month annualized basis, super core inflation was at 4.4% in March. This remains uncomfortably high for the Fed and will most likely force their hand to increase rates further. There was some positive news in the data. We saw rent inflation, a very sticky component of inflation generally. It slowed by 0.5% in March, down from 0.7% in February. Let's talk interest rates now. With the Fed Reserve meeting today and tomorrow, we'll have to wait until early Thursday morning, our time, to see what they've done on the back of their stubborn inflation story. As I noted earlier, most economists are predicting the Fed will hike another 25 basis points, as not only is inflation still a problem, but employment is still too strong also. Now, that's a perfect segue to talk about the employment story. And now we see that the latest data at the time of this recording was back in March data, showing that the US unemployment rate edging down to 3.5% from 3.6%. The number of unemployed people decreased by 97,000 to a reading of 5.84 million, and employment levels rose by 577,000 to a reading of 160.89 million. Their level of employment in percentage terms, being 3.5, is the same as here in Australia, which tells us that the US economy is still moving along at a pace the Fed would want to slow down. Consumer sentiment now, and the University of Michigan's consumer sentiment for the US increased to a reading of 63.5 in April, and that was from a reading of 62 in March. Now, this was in line with preliminary estimates. A rise was seen in both current conditions, a reading of 68.2 versus 66.3 in March, and in expectations, a reading of 60.5 versus 59.4. These improvements were balanced by worsening assessments of personal finance due to higher expenses, reflecting the ongoing pain stemming from continued high prices as inflation rolls throughout the economy. Now, in another measure, the consumer confidence data, which is separate to the University of Michigan's report, showed that consumer confidence dropped in April to its lowest levels since July. This is with the index falling to a reading of 101.3 points from a reading of 104 last month. Markets are expecting consumer confidence to remain unchanged in April at a reading of 104, but it obviously has deteriorated. Consumers' short-term outlook for income, business, and labour market conditions fell to a reading of 68.1 points from an even 74 last month. What's important to note here is this sub-index has remained below 80, which is the level associated with a recession occurring within the next year. So every month since February of 2022, except for a brief uptick in December of 2022, this reading has been below 80. So is the US in a recession? The unemployment story is telling us not yet, but remember the Fed is trying to slow the economy to curb inflation. So it's definitely heading towards a recessionary outcome if rates stay higher for longer. Let's round out the US data with a look at their March GDP numbers. And we saw the US economy grew by an annualized 1.1% in Q1 of 2023, slowing from a 2.6% expansion in the previous quarter and missing market expectations of a 2% growth figure, according to preliminary estimates reported. It was the weakest pace of expansion since Q2 of 2022 as business investments growth slowed down, inventories declined, and rising interest rates continue to hurt the housing market. These trends support the argument the US might fall into recession either later this year or early next year. Okay, so in summing up, the US continues to face economic headwinds, as does the rest of the developed world. They have also got big government stimulus spending problems, which have also been linked through research to increasing spending, and that has contributed to this higher US inflation story. Going forward, the US debt ceiling, this is a big political football being kicked around. And so the president needs the Congress to pass his future debt ceiling bills, but it's clear that this isn't going to be an easy process. One can expect plenty of argy-bargy over the next 12 months on this front. And although it's politics, it really does have a flow-on effect to credit ratings, downgrades, which impacts the cost of money and the broader confidence in the US economy overall, as it continues to already slow due to these interest rate increases. Add to this, President Biden announced he wants to go around again for another 4 years, and it's looking like Donald Trump is going to be his sparring partner once again. This combination is going to be an ugly contest, and it's set to further divide an already divided nation. It's very much going to be interesting times ahead for the superpower nation of the world. All right, let's look at China now. We look at their numbers over the past month and we see inflation still remains benign in China. The consumer price index, CPI, rose 0.7 of 1% year on year, the slowest pace in 18 months and weaker than the 1% gain in February. The result fell short of the 1% rise expected by consensus, with the latest monthly reading of a decline of 0.3 of 1% in the March reading. So nothing really to see here other than the repeat that inflation is currently not a problem in China. In terms of, with his inflation story under control, the Central Bank of China effectively did nothing, as they've done over the past 8 months, leaving current interest rates at their current settings. In terms of their employment story, China's surveyed urban unemployment rate declined to a 7-month low of 5.3% in March 2023, from February's 3-month high of 5.6%. The unemployment rate of the population aged 25 to 59 declined to 4.3% in March, from a reading of 4.8% in February, whilst those aged 16 to 24 increased from 19.6% from a reading of 18.1%. The average weekly working hours of employees in enterprises across the country increased to 48.7 in March, from a reading of 47.9 in the previous month. So in the first quarter of the year, the unemployment rate edged down to 5.5% from 5.6% in quarter 4 of 2022. The Chinese government has targeted a jobless rate target of around 5.5% by the end of 2023, with the creation of another 12 million new urban jobs as they continue to accept getting on with life post the heights of COVID. In terms of their GDP results for the March quarter, we saw economic activity expanded by 4.5% over the year to the March quarter. This was stronger than the 4% the market was expecting, and the 2.9% growth rate recorded over the year to December quarter 2022. The strong outcome was underpinned by a strong pickup in consumer spending. Over the year to the month of March 23, retail trade grew by a massive 10.6%, the biggest gain since June of 2021. This was a significant step from the annual 3.5% growth rate in both months in January and February. In summing up China's economic story, it really is one of getting back on the bike and getting their economic flywheel turning at a pace it was turning before COVID hit. China is getting back to full capacity in terms of its economic story, and that's good news for global inflation, as more competition for goods means lower prices in terms of global trade for goods and services. Time for the Eurozone data now, and we'll start also again with the inflation story. Headline annual inflation was finalised at 6.9% in March, unchanged from the preliminary reading. As I reported in my previous update, this was an improvement on February's reading of 8.5% and marked the 5th consecutive monthly decline since peaking in October last year. The core consumer price index was similarly unchanged at 5.7% in annual terms, but still remains at its highest level on record, which remains a problem. In some good news, the cost of energy declined for the first time in 2 years by 0.9 of 1% compared to an increase of 13.7% in February. Now, in not so good news, services inflation accelerated to 5% higher than the 4.8% recorded in February of 2023. Higher core inflation and accelerating services inflation continues to put pressure on policymakers to push on with further interest rate hikes for the Eurozone. Now, just like the US, the ECB doesn't meet in April, so they will be deciding their move on monetary policy later this week on the 4th of May. Markets are expecting another 0.25% increase in interest rates on the back of high core inflation. In terms of their economic story in the Eurozone, the latest data released was back in February. So we've talked about that unemployment story before, but it's sitting at 6.6%. The next lot of data doesn't drop until tomorrow, so we'll do a further update on that next month. In terms of their quarterly GDP story for the March quarter, it was released last week, and the data has revealed that they've just avoided a technical recession as this group of companies' gross domestic production grew by 0.1 of 1% for the March quarter, noting that this is a preliminary estimate and it's on the back of flat results for the December quarter of last year. Now, amongst the Eurozone's largest economies, Germany registered no growth for the first quarter, while the economies of France, Italy, and Spain did expand, but only slightly. So let's sum up the Eurozone. It's still a story of an ongoing war in Ukraine, and inflation is still having significant impacts on the cost of living over there. The Eurozone is still facing an uphill battle to get their economies back on track. So before I close out the rest of the World Economic Update, I must talk about the train wreck that is the UK economy. Now, since their Brexit decision, their economy is continuing to spiral further into the abyss. The latest inflation result was a staggering 10.1% for the March quarter. What's making matters worse is this false dreams that were sold to the Brits around their Brexit and, the story of a better quality of life. What has been playing out is the complete opposite, and people have turned on their government as cost of living blooms out of control. They have record debt, an economy that is going backwards fast, worsening unemployment, but I must admit it's still pretty low at 3.8%. They've got a rudderless government. They've got a terrible balance of trade account story. They've got falling retail sales, record rents, and no investment into property on the back of investors deserting the market due to government interventions. Now, to cap all of this off, they have a government that's caving in to strikes and union pressures, which is resulting in them in agreeing to larger wage increases. Now, this is the perfect playbook for a wage price spiral outcome, pretty much enshrining inflation will stay higher for longer, and the bottoming out of the UK economy is going to be more severe and uglier than it needed to be. Now, why am I telling you this message? Well, that's why you always hear our governor of the RBA talking about the dangers of high inflation hanging around. So if you're not sure about how dangerous it can be, look no further than the UK and watch what's playing out over there. It's going to be much worse before it gets better for this proud nation, and obviously, anointing their new king. So from an economic management point of view and perspective, we certainly do not want to be following the UK in their footsteps. Okay, so let's talk about how our story is currently playing out here in Australia. As we always do, let's start with Dr. Lowe and the Reserve Bank Board's decision at their board meeting today. Whilst every board meeting right now remains a live meeting, what did they decide to do? Well, they decided to increase the cash rate a further 0.25%, taking the cash rate to a reading of 3.85. This decision surprised the money markets, who were only pricing in about a 10% chance of a cash rate increase for the month. For mine, this surprise move has a logic around this idea of a household jolt, I'm calling it, meaning that the RBA saw the need to curb the risk of inflation remaining higher for longer, which is what they're seeing occur in other countries like what we talked about in the US, the Eurozone, and even the basket case of the UK, where inflation has remained stubbornly high. It's clear from the decision the RBA doesn't want Australia having the same sticky inflation challenges that they're seeing play out elsewhere. By delivering this further jolt to households, the RBA are again saying spend less and don't accept prices businesses are putting in front of you. And their messages from the business, or their messages for the business community, I should say, is this rate increase should further dent the confidence and ambition of businesses going forward. One thing the RBA can count on is that the media will do their best in telling us a gloom and doom story narrative. And this will add to the negative sentiment, which will assist the RBA's agenda in accelerating the decline in inflation over the short term. In rounding out the RBA decisions today, it is true to say most of us were surprised by the RBA's call to move the cash rate higher. So that we don't get surprised next time, I'll repeat what I've been saying for the past 6 months. It's time we do less spending so we can play our role in getting inflation under control and interest rates down sooner. I've been saying that for a while, and I'll keep saying it until we see further and further declines in economic activity and economic spending. Before we move on from the Reserve Bank of Australia, earlier last month, a report titled "An RBA Fit for the Future" was released, with 51 recommendations for changes to the way the bank operates. Now, I'm not going to talk about all 51 of those recommendations, but what I do want to do is go a bit off script and share a couple of thoughts regarding this review. My first comment is more broad regarding the RBA taking the full blame for the recent series of aggressive rate rises. Whilst the RBA has admitted they underestimated the inflation story, and with the benefit of hindsight, they would have moved rates higher earlier, we should all never forget that monetary policy, i.e. setting interest rates to speed up or slow down the economy, is a blunt tool to do this important work with. One can argue that having these lower rates for longer meant people had more disposable money, and this has led to record levels of savings and now record levels of spending, which has been inflationary. This is true, but the RBA didn't spend your money for you. Households did, and those households have accepted increased prices from businesses and what they're charging us. That's what's really caused goods and services or demand side inflation, not the fact that we have more money in our savings accounts. The RBA didn't force us to spend our money. We made that decision. Sure, it's hard, if not impossible, for us not to accept increases in electricity, gas, petrol, and even basic essential foods. But inflation isn't just at its current levels because of those items. Remembering core inflation strips out those items. So my first point here is we can't really blame the RBA for putting rates up. We are the consumers, and we need to take account and blame for some of those spending actions. I've stated this important point before, and I'll state it again here for those new to my economic and RBA updates. And that is, always remember that the economy is a measure of activity of the people, businesses, and government spending within it. It's not a made-up number. So it really is important to understand that the RBA are forced to move with this blunt instrument based on the actions of those participating in the economy. Let's move to point number 2, and let's turn our attentions now to that government story, remembering that governments run fiscal policy, and they also set the laws and regulations of the land. Now, I'm really going to go on a little bit of a rant here about how governments play a role. In fact, in my view, they play a significant role in terms of their inflationary impacts on the decisions that they make around monetary policy. And I'm going to give you a couple of examples right now, starting with energy and climate policy. So through the past couple of decades, the last 20 years, the action of our esteemed politicians over those 20 years, we now find ourselves with some of the highest electricity prices in the developed world. For example, compared to the US, our electricity costs are 31% more expensive based on 2022 prices. And we know from the government and what the news media are telling us, those energy prices or our electricity prices really across Australia are going to rise another 25% this year, whereas electricity prices in the US are set to remain flat. Now, the cost of electricity is a critical input in goods and services. And obviously it's critical in the sense of the energy prices we pay, so those electricities we pay at home, but also it's a critical input in terms of the goods and services that are created by businesses of which we participate in. So when the governments of the day play a political football game with core components of the economy such as energy production, we, the people, get hurt. Now, a good example of this is when Bob Brown and the Greens Party got greedy. They didn't quite get the proposal on the carbon tax on the table that they were looking for. Now, their decision to not pass that, when it had bipartisan support from both Liberal and Labor at the time, has resulted in a sliding doors moment that's resulted in no carbon tax and 20 years of energy policy and uncertainty, which has resulted in inadequate business investment in renewable energy. And here we are today, paying super high electricity costs from those 20 years of little action. Now, as a side note, and doesn't this really, bring out the irony here, that the Greens, who are effectively the champions of climate policy, have potentially been one of the biggest contributors to further climate challenges, as opposed to climate improvements with the poor decisions that they made back then. Now, here's another example. Again, I'm also talking about the politics around property at the moment. So the Greens and the Labor Party are heavily involved. Over these last few years, both at state Labor and with a lot of Green pressure in terms of that political vote that they're trying to get, have embarked on a series of law reforms in the property investment space. Now, fortunately, some of those proposals, like banning negative gearing, changing tax on property owned interstate, or charging tax, I should say, on properties owned interstate, and charging higher council rate for investment properties, have failed to be enshrined in law. That is massive. But other macro-prudential interference by the likes of the regulator APRA in the form of throttling investment and lending to investors has occurred, and this has resulted in less lending for investors and higher borrowing costs for those investors, even though the data shows that property investors are a lower risk of default to banks. In addition, significant tenancy reforms, adding higher holding costs and resulting in control over one's property, or less control over one's property. The net effect of this intervention in the marketplace by government and regulators is resulted in less demand and less supply for rental properties. Now, we know less supply means higher rents. Higher rents add to inflation. Higher inflation adds to higher interest rates, which further reduces supply because higher interest rates means less borrowing power. So it's a vicious cycle, and so higher rents again. So it's really, really important that we understand this message, and that is that there are other countless examples of how poor political decisions have inflationary outcomes. And it's also important that we need to make sure that we're holding our politicians to account and our regulators to account, so that these causes of inflation don't continually to be a feedback loop. And it obviously makes the work for the RBA so much harder. They are left with the heavy lifting to do and mopping up the mess from those governments, and obviously businesses failing to make that investment, which puts competition, which puts price pressures down, and we as consumers in terms of how we behave. All of that then rests on the shoulders of the RBA to do the heavy lifting with the blunt instrument that they've got. Okay, so what does this little side rant here have to do with the RBA review? Well, when the optics have the RBA as the only villain in the higher interest rate story, it's misleading the public and it's misleading public opinion that the RBA aren't doing their job well when it comes to, once again, understanding it's a super blunt instrument for them to do their monetary policy work. Yes, they got the inflation story wrong. After the war started in Ukraine and also China's impacting global supply chains, and they admitted that their projections for rates staying low until 2024 was the wrong call. So they don't have a perfect record. However, there is no evidence to suggest that the RBA has performed worse than other central banks in navigating these times of the pandemic, the supply chain challenges, and the war in Ukraine. No other central bankers around the world saw inflation spike coming. No other central banks held off on lower interest rates to emergency settings, nor did any governments refrain from broad spending packages to support their citizens through the peak of the pandemic. So if it isn't broke, what are they trying to fix? Why are we conforming to the rest of the world in terms of how other central banks are set up and operate? Are we doing this for political point scoring? Well, maybe. It's hard for us to have a review without recommended changes. So here we are with a review of the RBA and 51 recommended changes, and I've still got some question marks in terms of, are they doing as bad a job as everyone expects? Well, the optics certainly show that, but what I'm telling you is that there's more to that story. Anyway, what we have got is 51 new recommendations for the RBA to be fit for the future. So let's just highlight a couple of those relating to monetary policy. They are recommending a new board that just looks after the monetary policy decisions. This means that the current board makeup, which consists of 2 RBA members, a Treasury Secretary, 5 business people, and an academic, under the recommendations, this will change to a monetary policy board that's made up of the RBA Governor, the Deputy Governor, the Treasury Secretary, and 6 external members. Now, with those external members serving on the board for a 5-year term with a staggered ending date, and they would have specialisation in macroeconomics, the financial system and labour markets, and would be recruited transparently. Now, this would then leave the other functions of the central bank to be run via a corporate governance board, focusing on the day-to-day operations of the central bank, and they wouldn't have a say in monetary policy decisions. Another recommendation worth noting was the tweak to the RBA mandate. Originally set way back in 1959, with a focus on inflation, unemployment, and economic prosperity, the review recommended this mandate now just focus on inflation and employment. Now, for mine, there's evidence of the governor and the board actually dismissing this whole idea of economic prosperity, and they've done that through the governor basically talking about it's not his job to set house prices, whereas one could argue that house prices are a measure of economic prosperity of the people inside that country. Anyway, that's effectively what they've set in terms of their recommendation. They did also review the recommendation around the inflation target rate, and they've kept that the same at a reading of 2 to 3%. Now, continuing, the takeaways for mine were the commitment to a post-decision media conference to explain the board's decision in more detail. Now, this might be helpful so long as people tune in and really listen to the messages that the governor will be saying at that press conference. And one recommendation that concerns me in regards to the rate decision is basically the reporting, the public reporting on what decision each board member made. Now, it's still going to be effectively an anonymous decision, but we will be able to see how many people voted the rate increase or decrease or keep the rate at the same level. Now, the reason why I'm concerned about that is that whilst it's important to have discussion and potential disagreement within the board is a very healthy thing, once a decision is made by a board, unity of that decision is important for confidence and stability. So, any public broadcasting of this decision means that the media will be able to get a hold of it. They might distort it, hype it up. And so there could be some unintended consequences and also showing potential disunity amongst the board. And that does not support the idea of this sort of idea of confidence and stability in our central bank. So I'm unconvinced that this is a good thing at all. So in concluding my thoughts on the review, I've had my rant, the monetary policy settings perspective. I do feel like, fortunately, that most of the review has been a little bit of window dressing at the edges, which I think, frankly, is a good thing. And from my point of view, hopefully they'll keep most of the good things that are working with the board in place and only play around with the edges. And one final thought on this is maybe there is some good news for me, for those people who have to handle my 11 economic updates every month. We may be able to move that back down to 8, because one of the other recommendations was less monthly meetings and only 8 meetings throughout the course of the year, as opposed to 11 having the only break in January. Okay, so that wraps up a big update in regards to the Reserve Bank of Australia, not only the cash rate, but also a review of their fit for purpose story. Let's now talk about inflation data and what do we learn in the March quarter. We saw that the March quarter inflation report confirmed that inflation has passed a peak in the December quarter of 2022. The consumer price index, the CPI, rose 7% over the year to the March quarter, slowing from a near 33-year high of 7.8% in the December quarter. Now, the March quarter result was an increase of 1.4% over that quarter. Now, if this latest read were to play out over the next full year, our inflation read would still be running at 5.3%. So hopefully inflation continues to slow, because if it keeps up running at this level, we're going to need to do more in terms of the cash rate to bring that inflation pace down rather than up. Over the quarter, services prices rose 1.7% to be 6.1% higher in annual terms. This is the fastest annual pace of services inflation in almost 22 years. And as I mentioned in my past two updates, services inflation is where we need to see further falls as goods inflation is improving quicker. Property rental increases are also putting further upward pressure on inflation, as they don't look set to drop anytime soon. And we'll talk about those increases in rents later on in this update. Okay, employment data now, and we see employment jumped 53,000 in the March, in a sign that the current business conditions are holding up. The increase in employment outpaced the larger 51.4 rise in the labour force. This resulted in the fall in the number of unemployed workers, leaving the unemployment rate unchanged at 3.5%, same as the US. The working population expanded by 481,500 people over the year to March, the biggest annual increase on record, as the influx of immigrants are looked for and are currently finding work. As more immigrants arrive, there will be a tipping point, and as the economy slows and less people will find work, we will start to see that play out more over the coming quarters of this year, and the unemployment rate will start to rise, basically from its record lows. In terms of consumer sentiment now, we saw consumer sentiment jump 9.4% in April following the RBA's pausing of interest rates. Those with mortgages showed an increase of 12.2%. This was the strongest monthly gain since October of 2020. Naturally, housing is the most interest rate sensitive part of the economy right now, making it logical that housing related measures surged. Let's run through some of those now. The time to buy a dwelling index jumped 8.2% to a reading of 71.1, its largest monthly gain since November of 2021. We saw surges in New South Wales with a reading of 17.6% increase, Queensland 12.5 and WA 11.9. House price expectations also shifted higher to a reading of 130.3 index points, a 16.6% increase in the month. Also not surprising, after 11 straight rate rises, we've seen expectations around economic conditions, positive 16.5, and family finances, positive 12% over the next 12 months. Views around family finances over the past 12 months were also up 10.5% on the back of this pause in interest rates. Longer term expectations for the economy were slightly higher, whilst the time to buy a major household item jumped 9.5%, but remained deeply negative at 82.1. Remembering that readings above 100 indicate optimistic outlooks and below 100 pessimistic outlooks. So that reading of 82.1 is still very much in pessimistic territory. And this means we need to be reminding ourselves that despite the logical April bounce that we got, sentiment remains deeply entrenched in pessimistic territory, and it could take some time for that to swing around. And right now, the RBA doesn't want that to swing around anyway. They need businesses hurting more. They want them reducing prices to curb inflation instead of having to hit that cash rate lever again. Now, that's a good segue into the business story. And what do we see, starting with retail sales and consumer spending? Now, we don't have the retail sales data coming out and for the March quarter until tomorrow. But what I can draw upon is CBA's spending data story, given it's, in my view, their household spending intentions, their HSI report, is an excellent proxy, given that we don't have the ABS data in terms of retail spending. So with the CBA report data as our guide, what did we learn? Well, the CBA reported that their HSI index for March 23 rose by 8% in original terms, following declines in January and February. Now, the gains in March were led by a bounce in transport, entertainment, retail, and travel. The increase in March was partly due to a longer month and seasonal factors, with the HSI index up only marginally in seasonally adjusted terms. Importantly, from the RBA's perspective, in terms of them wanting spending to ease, the HSI report continues to show a moderation in spending, down to 3.8% growth over the year compared to 4.6% growth over the year to February. So for context, the peak of this reading was 15.2% back in August of last year. So even though we've had a mini population boom, which is adding to increased spending, the RBA super cycle of rate tightening is starting to bite, and CBA economists expect this trend to continue as these households with mortgages continue to see their disposable income being taken away from them in terms of higher mortgage repayments. So we're trending in the right direction when it comes to consumer spending. In terms of the business data, we saw business conditions, remembering this is the here and now story, remained elevated in March at a plus 16 index points. Despite slipping for a second consecutive month, falling by -2 index points. So it is coming down. Conditions continue to remain well above their 10-year average of a reading of 8.7, suggesting that current momentum in the economy, while slowing, still remains quite strong. Now, the confidence story, now remember this is the forward-looking indicator, rose +3 index points to a reading of -1. So it was at -4, it's now back to -1. This reflects a partial rebound from the large February drop when the RBA told us that they had more work to do to curb inflation and to obviously raise rates. It's also important to note the survey was undertaken between the 21st and the 31st of March prior to the Reserve Bank pausing rates in April. Okay, so that could also give it an additional bounce. It will be interesting to see if confidence returns to a positive setting when we get the first post-pause reading. I'm not sure the RBA will actually be too happy about a positive business outlook. Again, they want business activity to be cooling off, not holding steady or growing. Trading conditions now, and we saw trading conditions improved whilst profitability and employment conditions slipped. Forward orders, a leading indicator, rose and remained above average. Capacity utilisation held well above average, suggesting that businesses are continuing to see robust demand. Again, this is not great reading for the inflation story. If profits and employment conditions are under pressure, but demand is strong, what do businesses do? Businesses keep trying on putting their prices up, and that will ultimately be recorded as inflationary. So that's not good news for the RBA, and we've got to make sure that those business conditions start to reduce. Now, in some good news, quarterly costs growth declined materially. Labour costs slowed by 1.9% in March from a 2.5 and 2.6% pace in the previous 2 months. Purchase costs also dropped sharply to 1.8% from 3%, suggesting that supply side pressures have eased markedly. That is good news. Those input costs are important in terms of the overall costs we pay as consumers. Reductions in upstream pressures flowed through to final prices, where we saw final product prices growth slipped to 1.2% from a reading of 1.6%, and the retail component slowed to 1.6% from 2%. So they are trending in the right direction. All right, so that wraps up the economy, inflation, unemployment. Let's talk property now, starting with our lending data. Now, monthly housing credit growth grew by only 0.3% over March, slightly down from the 0.34 recorded in February. The underlying trend for housing credit growth continues to soften. Over the 3 months to March, housing credit averaged 0.3% per month. This is half the average growth rate of 0.6 recorded in the corresponding quarter just a year ago. Growth in owner-occupied credit ticked down, whilst we did see a partial offset through a tick up in investment housing credit. There are suggestions that investors could be responding to higher expected yields from higher rents and strong demand for rental housing. There is also some logic that in this, as I suspect, there were a lot of investors potentially sitting on the sidelines, seeing what was going to happen with interest rates. In terms of building approvals data for March doesn't actually get published until next Monday. So I'll give an update on those numbers then. But there were obviously several notable building collapses, including the likes of Porter Davis in this past month. And so I'm not expecting the numbers to be pleasant reading at all when we get those building approval numbers and the challenges happening around the property market at the moment. In terms of property values results, we saw, looking at the data from our good friends at CoreLogic, we saw another month of growth of dwellings across Australia. So after falling 9.1% between May of 2022 and February of 2023, the CoreLogic National Home Value Index, their HVI, increased by 0.5% following the 0.6 rise we saw in March. And it's now 1% higher over the past 3 months. Now, according to Tim Lawless, our good friend Tim, CoreLogic's research director, we have reached an inflection point, referring to the view that we have potentially passed through the bottom of the market. So why is this so? Well, the main reason is still the level of supply. So for context, the rolling 4-week new listings tracking is around 14% below average at this time of year. And we can see that demonstrated in the graph if you're watching the video. And the overall listings across Australia is tracking 21.8% below the 5-year average of this time of the year. So this tight supply isn't meeting the current demand in the market, driven by buyers looking to act, because the alternative option of renting isn't that appealing right now either. So according to Tim, additional demand could also be coming from increased immigration, whereby cashed up immigrants are potentially skipping the rent before they buy process and going straight to that buying stage. Current elevated auction clearance rates from their long-term average levels is further support that demand is about for limited stock on offer. As I mentioned last month, we know there are sellers and buyers that have been sitting on the sidelines waiting for interest rates to come off the boil. So again, it's going to be an interesting time over the short term to see how many sellers enter the ring over the coming months, and basically just what sort of level of demand we have in the market, or whether those sellers will wait until spring before they list their properties. So that will be one to watch. In terms of looking at the data, just quickly, Sydney's prices for the month grew by 1.3%, Melbourne by 0.1%, Brisbane by 0.3%, Adelaide up by 0.2%, Perth up 0.6%, Hobart flat, Darwin negative 1.2%, and Canberra flat. So combined capitals positive 0.7%, combined regions positive 0.1%. But for a national, how they rebalance that nationally, it equates to a 0.5% increase. Now, I promised a bit of a deep dive into the rental story. So here we go. Looking at rental yields, story for the year through CoreLogic's reporting. They reported a 1.1% rise across the combined capitals in April, and regional rents were up by 0.5%. So let's run through some of those numbers in more detail now. So I'm going to start with the annual change in rents for houses. We see that Perth's annual change is positive 13.1%, Adelaide positive 10.7%, Brisbane positive 10.3%, Sydney positive 9.6%, Melbourne positive 9.1%, Hobart positive 3.1%, Darwin positive 2.3%, and Canberra negative 1.8%. In terms of the annual change in rent for units, so that was rents for houses, just for a correction there. This is now units. Sydney 19.1%, Brisbane 16.5%, Melbourne 15.2%, Perth 13.6%, Adelaide 12.1%, Hobart 7.2%, Darwin 7%, and Canberra also positive this time around at 2.4%. So as we've just heard, the growth in unit rents is significantly outpacing the rise in houses rents. Across the combined capital, unit rents are up 1.6% versus house rents are up 0.9% in April. Unit rents suffered significantly through the pandemic, and since early 2022, as the Australian marketplace or Australia started to open up, unit rental growth has been outpacing house growth. Now that's reversing the trend that we saw during the pandemic, where we did see unit rents drop significantly during that time. So I'm continuing on this deep dive. So finally, let's take a deeper dive into the current rental yields that we're seeing for both houses and also units across our capital cities. So Sydney house prices, 2.8% yields. Units, 4.1% yields. Melbourne houses, 3.4. Units, 4.5. Brisbane houses, 4.1% rental yield. Units, 5.4. Adelaide houses, 3.9%. Units, 5.2. Perth houses, 4.7. Units, 6.4. Hobart houses, 4.3%. Units, 5%. Darwin houses, 5.8%. Units, 7.5%. Canberra houses, 3.8%, and units, 5.1%. So a real clear differentiation in terms of household yields or house yields versus unit yields. And it's clear why. House prices have significantly outperformed unit prices effectively over the last 5 to 7 years. So we're definitely seeing that those house price yields are lower. They have been improving, obviously, since we've seen this rental demand start to occur, but very healthy yields in the unit side and still improving household yields in regards to the house side. Okay, so there's plenty of data there for you to mull over as we've gone through the housing story there. Let's summarise some of the key points from the overall update itself. Remembering that obviously the Republic First Bank in the US is going to potentially be sold, so we'll learn more about that and that announcement in the coming days. That is obviously something to watch in terms of the more broader risk in the banking sector in the US and whether that has a contagion effect also into Europe. I wanted to also remind everyone about the RBA review. It has been done. It's obviously good news that most of it's just tweaks made around monetary policy decisions to be more transparent, which in turn leads to more everyday Australians understanding decisions that are basically eventuate at the end of each month's rate call. And at the end of the day, it's also important to remember that effectively it is a judgment call being made. It's an imperfect science that is the economy, and there will still be mistakes that will be made by this new monetary policy board if it actually gets legislated. And finally, I wanted to just talk more broadly around the inflation story and start to think a bit more medium and longer term. So as inflation moves back towards the RBA's target range of 2 to 3% over the next couple of years, I want you to ponder this thought. And that is, whilst it's also worth remembering that sustainably high inflation is completely disastrous for standard of living and society as a whole, short-term spurts of inflation, when brought back under control, it's always important to bring them back under control, do actually have positive impact on asset prices, like existing houses, generally speaking, because it increases the cost to build, making the substitution of existing property more worthwhile and more valuable as that demand increases. So if it costs more to build versus buy existing, so it moves that value higher. Furthermore, short bursts in inflation usually leaves us with higher wages than we had prior to that inflation run. Now, higher incomes equates to increased borrowing power, which usually puts upward pressure on house prices over the long term. So inflation is bad. Sustained inflation is really bad. Short spikes of inflation can reset things a little bit. And And then ultimately, once you get inflation back under control, you potentially see those asset values hold their ground when it comes to appreciating assets like property. So that's food for thought around medium to long-term price growth for households. Well, it has been one huge economic update. They always are for April. So thank you for hanging around to the end. And always remember, until next month, knowledge is empowering, but only if you act on it. So we'll see you again next month, folks.